The 85% tax nobody talks about January 2026 Social Security COLA trap. Most retirees think Social Security is tax-free. It's not. Up to 85% of your Social Security benefits can be taxable income. The taxation thresholds haven't been adjusted since 1984, frozen for over 41 years. Each year, inflation pushes more retirees into taxable brackets, and this January 2026 COLA increase will trigger this trap for thousands of new retirees. Today, we're breaking down the 4 major tax impacts your CPAs probably won't explain clearly. Welcome to the most comprehensive breakdown of Social Security taxation you'll find anywhere. Here's what shocked me. A retiree I know got a Social Security raise this month. It was supposed to help. Instead, it triggered $2,000 in new federal taxes and another $1,500 in Medicare surcharges. That's an 85% tax rate on the increase. And this happens to roughly 3 million retirees every January. Today we're breaking down the 4 tax impacts your CPAs probably won't explain clearly. We'll cover how Social Security taxation actually works using the frozen thresholds from 1984, the January 2026 COLA impact with real scenarios, the hidden Medicare IRMAA trap that doubles down on taxation, and strategic planning opportunities to minimize your tax burden. By the end of this video, you'll understand the combined income formula, see exactly how much of your benefits become taxable, and have actionable strategies to reduce your tax liability. This information is educational based on IRS Publication 590A and IRC Section 86. Consult a tax professional for your specific situation. It's January 2026. Your Social Security just increased. But here's the catch: that raise just triggered unexpected federal taxes and Medicare surcharges. Up to 85% of your new benefit can be taxable income. The thresholds haven't budged since 1984. Inflation keeps pushing more retirees into taxable brackets every single year. Today we're breaking down exactly how this works and what you can do about it. The letter says it's good news. A cost of living adjustment. A raise. Your benefit went up $1,100 for the year. You feel it for about 2 weeks. That's the window when the realization hits. Not the COLA increase itself, but the phantom tax attached to it. For roughly 2 weeks, retirees experience that nagging sense that something's wrong. I got a raise, but my take-home didn't increase. Then it fades, until January when they file taxes and discover the 85% effective tax rate on the increase. You felt it. You just didn't know why. Then tax season hits. You file your return, and you discover something that wasn't in the letter. That $1,100 increase triggered $935 in new federal taxes and $560 in higher Medicare premiums. You got a raise. You're paying 127% in taxes on it. Here's what just happened. Your Social Security benefit increased with the COLA adjustment, but that increase pushed your combined income over the taxation threshold. Now up to 85% of your benefits are taxable, plus Medicare IRMAA premiums jumped. That's not a raise, that's a tax trap. The thresholds have been frozen since 1984. Inflation does the rest. This is happening right now to nearly 3 million retirees. Not because they did anything wrong, but because Congress froze Social Security tax thresholds in 1984 and never adjusted them. Not once, for 42 years. Inflation moved, thresholds didn't. And now the system is catching up. Those income thresholds, $32,000 for married filers, $25,000 for singles. They haven't budged since 1984, 41 years. But your Social Security benefits? They increase every January with the COLA, which means each year, more of your benefits cross into taxable territory. The system finally catches up to the inflation that's been building for decades. But the math tells a different story. Since 1984, those thresholds haven't budged, not once. Meanwhile, inflation compounds every single year. Your Social Security increase, much of it gets taxed away. The numbers don't lie. Hi, this is Mark. I'm here to help you understand Social Security taxation in 2026. And the COLA trap that catches millions of retirees, phonetics COLU for COLA. What you're about to see is how a benefit increase becomes a tax increase. How frozen numbers from the 1980s now control retirement income for millions. And why your CPA might not even notice it happening. Scene 12 requires narration text input. Provide the specific dialogue or narration for this scene to generate proper subtitles, visual direction, and image-to-video instructions. No value detected in input. In 1984, Congress set the Social Security taxation thresholds at $32,000 for married couples and $25,000 for single filers. That was 42 years ago. Since then, inflation has eroded purchasing power by over 300%. Yet these thresholds? Frozen solid. This is the number that froze in time, and it's costing retirees thousands every January. The foundation of this trap is two specific dollar amounts, $32,000 and $44,000. These are the Social Security taxation thresholds for married couples filing jointly. And here's what shocks most retirees. They've been frozen since 1984. That's 41 years of inflation. But zero threshold adjustment, which means every year, thousands of retirees get pushed into taxable brackets they didn't expect. The 2026 COLA increase will make this worse or better, depending on whether you understand how these two numbers control 85% of your Social Security benefit taxation. If you're married filing jointly, the threshold is $32,000. This is the critical number, frozen since 1984, that determines whether your Social Security benefits get taxed. Any combined income above this amount starts triggering taxation on your benefits. For couples, this $32,000 threshold is the first tier. Stay below it, and your Social Security stays tax-free. Cross it, and up to 85% of your benefits can become taxable income. If you're single, it's $25,000, that's the threshold. Stay below it, zero Social Security tax. Go above it, up to 85% becomes taxables. These aren't your income. They're not your Social Security benefit. There's something called combined income, and it's a formula the IRS uses to determine how much of your Social Security becomes taxable. Here's the formula behind Social Security taxation that most retirees never see. Combined income equals your adjusted gross income, plus 50% of your Social Security benefits, plus any tax-exempt interest. This single number determines how much of your benefits become taxable income. The IRS uses a two-tier system. Tier 1 if combined income exceeds $32,000 for married filing jointly. That threshold frozen since 1984, up to 50% of the excess becomes taxable, capped at 50% of total benefits. Tier 2 if combined income exceeds $44,000, up to 85% of the excess becomes taxable, plus any Tier 1 amount not yet taxed, with a maximum of 85% of total benefits. Here's the real shock. A retired couple with $60,000 in AGI, $36,000 in Social Security, and zero tax-exempt interest calculates combined income of $78,000. That's $46,000 over the Tier 1 threshold. 50% of $46,000 equals $23,000, but it's capped at 50% of benefits, $18,000. Then Tier 2, $78,000 minus $44,000 equals $34,000 times 85% equals $28,900 minus the $18,000, already taxed in Tier 1, leaves $10,900 more taxable. Total $28,900 of the $36,000. Social Security benefit becomes taxable, 8,025%, and at a 22% tax bracket, that's $6,358 in federal tax on benefits alone. Your adjusted gross income plus half of your Social Security benefits plus any tax-exempt interest you earned. This is your combined income, the number that determines how much of your benefits get taxed. This is the critical formula the IRS uses in Publication 590A, Worksheet 3. Most retirees have never seen it, but it controls whether you pay $0 in Social Security tax or up to 85% of your benefits. That total, that's your combined income. It's your AGI plus 50% of your Social Security benefits plus any tax-exempt interest. This single number right here determines how much of your Social Security becomes taxable income. And for many retirees, it triggers up to 85% taxation on benefits. And the moment it exceeds $32,000 if married, the taxation starts. This threshold, frozen since 1984, while inflation climbs every year, these numbers don't budge. So when your Social Security increases, you cross over up to 85% of your benefits become taxable income. That raise you counted on, it becomes a tax bill instead. What people think this means, I'll probably owe a little tax on my Social Security if I have other income. But here's the misconception. Most retirees underestimate how much of their Social Security is actually taxable. With the frozen threshold since 1984 and the January 2026 COLA increase, up to 85% of your benefits can become taxable income. This isn't a small adjustment for many retirees. It's a hidden tax bomb triggered by inflation alone. What actually happens, up to 85% of your entire Social Security benefit can be subject to federal income tax. This isn't just theoretical. It's the law under IRC Section 86. Most retirees think Social Security is tax-free. It's not. The taxation thresholds, they've been frozen since 1984. That's 41 years of inflation eating away at who qualifies as tax-free. Each January, when the cost of living adjustment hits, thousands of new retirees get pushed over the edge into taxation. They didn't expect. The first crack appears immediately. A hairline fracture spreads across the surface. The damage has begun. No turning back now. The January 2026 Social Security COLA trap explained. Up to 85% of your raise gets taxed away. Here's the math. When the math breaks, that's what happens every January when Social Security recipients get their COLA increase. You think you're getting a raise, but the taxation formula unchanged since 1984 catches up with you instantly. For millions of retirees, that raise becomes a tax bill. Up to 85% of your benefits can be taxable. The thresholds are frozen, inflation is not. This is where the real cost of retirement emerged. Let's follow a real couple. Married, both retired. No surprises ahead. Or are there? Pension from his job, $40,000 a year. This becomes part of his combined income calculation for Social Security taxation purposes. Investment income, dividends, interest, $15,000 a year. This is where most retirees miss the trap. That $15,000 doesn't just sit there. It's part of your combined income calculation that determines how much of your Social Security gets taxed. And remember, combined income includes 50% of your Social Security benefits plus any tax-exempt interest. So that $15,000 in investment income is pushing you directly into the higher taxation tiers. We're talking 50% taxation at Tier 1, potentially 85% at Tier 2. The frozen thresholds from 1984 mean inflation does all the work, your income didn't change, but suddenly more of your benefits are taxable. This is the hidden mechanism that catches retirees completely off guard. Combined Social Security benefits, $36,000 a year. Here's the shock: most retirees don't anticipate up to 85% of those benefits can be subject to federal income tax. The taxation thresholds, $32,000 for married filing jointly, $25,000 for single filers, have been frozen since 1984. That's 41 years without adjustment. Inflation hasn't stopped. Every January when the cost of living adjustment arrives, it pushes more retirees into taxable brackets. A couple receiving $36,000 combined in Social Security, with $60,000 in other income, will see roughly $29,000 of their benefits become taxable. That's 80%. And that's just federal income tax. The same income calculation triggers Medicare IRMAA surcharges, potentially adding another $2,000 annually. This is the hidden tax trap that catches 3 million retirees every year. Now calculate combined income AGI plus 50% of Social Security benefits plus any tax-exempt interest. This is the critical formula that determines how much of your Social Security becomes taxable income. $40,000 in pension income. This is where the taxation really becomes visible. When you combine your pension earnings with Social Security benefits, you trigger the combined income formula. That $40,000 pension added to your Social Security now determines how much of your benefits become taxable. Under the frozen thresholds from 1984, you're entering territory where up to 85% of your benefits could be subject to federal taxation. This is the critical moment where most retirees realize they've miscalculated their retirement income. The math is simple, but the impact is profound. Plus $7,500, which is half of the $36,000 in Social Security, plus $0 in tax-exempt interest. This means no additional income gets added to your combined income formula, which is the key calculation that determines how much of your Social Security benefits become taxable. Tax-exempt interest from municipal bonds or other qualified sources doesn't count toward the thresholds. So keeping this income separate helps minimize your overall tax burden on benefits. Combined household income equals $47,500 total. This includes pension income, investment returns, and Social Security benefits. This combined income figure is critical because it determines whether your Social Security benefits are taxable under IRS Section 86. For a married couple filing jointly, if your combined income exceeds $32,000, some of your Social Security becomes taxable at $47,500. You're well into the taxation zone. In fact, at this income level, up to 85% of your Social Security benefits could be subject to federal income tax. This is the formula most retirees don't understand until tax time arrives. This couple is now $15,500 above the $32,000 threshold. That's the critical line, their combined income, which includes 50% of their Social Security benefits plus all their other income, has crossed into the heavy taxation zone. Everything above that $32,000 line means up to 85% of their benefits become taxable income. This is exactly what happens to 3 million retirees every January when the COLA increase hits. In the first tier of Social Security taxation, 50% of that excess becomes taxable. If your combined income exceeds the $32,000 threshold for married filing jointly, or $25,000 for single filers, then 50% of the amount over that threshold becomes subject to federal income tax. This is Tier 1, the foundational layer of the two-tier Social Security taxation system established by IRC Section 86. 50% of $15,500 is $7,750. That's the Tier 1 taxable amount when your combined income crosses the threshold. Half your Social Security benefit becomes taxable income. This is how the formula works. Your AGI plus 50% of your benefits plus tax-exempt interest. When that total exceeds $32,000 for married filers, the excess gets multiplied by 50%. In this case, $7,750 in benefits suddenly becomes reportable income. For many retirees, this is the shock moment. A benefit meant to help becomes a tax liability. But there's a cap. The amount taxable under Tier 1 cannot exceed 50% of your total Social Security benefit. 50% of $36,000 is $18,000. This is the foundation of Social Security taxation. When the IRS calculates whether your benefits are taxable, they take 50% of your total Social Security benefits and add it to your other income. In this case, $36,000 in benefits becomes $18,000 in the formula. Combined income equals AGI plus 50% of Social Security benefits plus tax-exempt interest. This $18,000 figure is what pushes many retirees over the frozen thresholds from 1984. Understand this number, and you understand where your tax liability begins. So far, $7,750 of their benefits become taxable. But wait, their combined income is also $3,500 above the second threshold, which is $44,000. In Tier 2, different rules apply. Up to 85% of the excess over that threshold can become taxable. 85% of $3,500 is $2,975. That's how much of a hypothetical Social Security benefit becomes taxable under Tier 2 taxation. For a couple receiving $3,500 monthly in combined benefits, $2,975 per month or $35 plus $700 annually can be subject to federal income tax. This is the critical number most retirees never see coming. The IRS thresholds, frozen since 1984, push more beneficiaries into this 85% taxation bracket every single year. When your combined income calculated as AGI plus 50% of Social Security benefits plus tax-exempt interest exceeds $44,000 for married filing jointly, you enter Tier 2. Up to 85% of benefits become taxable. Add Medicare IRMAA, and that same combined income triggers a surcharge on your Part B and Part D premiums. A $2,975 monthly benefit that looked like a raise becomes $1,545 after federal tax at the 22% bracket. That's a 45% effective reduction. And when IRMAA kicks in with an additional $1,500 annually, your net benefit drops another $125 per month. This is the 85% tax trap nobody explains. Now combine both tiers. We've already counted $7,750 under Tier 1. We can add $2,975 more under Tier 2 before hitting the 85% cap on total benefits. Total taxable benefits, $10,725. This is the amount of your Social Security that the IRS considers taxable income. Up to 85% of your benefits can be subject to federal taxation, depending on your combined income, a calculation most retirees don't understand until they file. At a 22% federal tax rate, that's $2,359 in federal tax on their Social Security. This couple did nothing different. They just have other income. And now their Social Security is partially taxed? But this is where the cold math gets colder. The combined income formula is where the complexity lives. It's calculated as adjusted gross income, plus 50% of your Social Security benefits, plus any tax-exempt interest. This single number determines everything about your Social Security taxation. Here's why it matters. Up to 85% of your benefits can become taxable income. Most retirees think Social Security is tax-free. It's not. The taxation thresholds $32,000 for married filing jointly, $25,000 for single filers, haven't been adjusted since 1984. That's 41 years of frozen thresholds, while inflation compounds every single year. This January 2026, when the Social Security COLA increase hits, Thousands of new retirees will cross these thresholds for the first time. And here's the trap: that COLA increase goes directly into your combined income calculation, pushing you deeper into taxation. A retiree I know received a $576 annual COLA increase. Because of how the math works, roughly 85% of $6 annual COLA increase. Because of how the math works, roughly 85% of that increase became taxable. Her effective tax rate on the raise, 85%. That's before Medicare IRMAA surcharges kick in. Understanding this formula isn't just financial literacy. It's the difference between a comfortable retirement and unexpected tax bills that catch you completely off guard. Here's what shocked me. A retiree got a Social Security raise this month. It was supposed to help. Instead, it triggered $2,000 in new federal taxes, $500 in Medicare surcharges. That's an 85% tax rate on the increase. This happens to roughly 3 million retirees every January. Most think Social Security is tax-free. It's not. Up to 85% of your benefits can be taxable income. The taxation thresholds, they haven't been adjusted since 1984, frozen for 41 years each year. Inflation pushes more retirees into taxable brackets. Today, we're breaking down the 4 tax impacts your CPAs probably won't explain clearly. Now it's 2026. Social Security announced a cost of living adjustment. Cost of living adjustment. The COLA was 32%. KOHLU. That's the cost of living adjustment announced for Social Security benefits in 2026. While it sounds like good news, for this 32% increase will push thousands of retirees into higher tax brackets. Combined income rises, taxable benefits jump, and you'll pay federal taxes plus Medicare IRMAA surcharges on money you thought was a cost of living raise. For this couple, their combined Social Security benefit increased from $36,000 to $37,152. That's a $1,152 annual raise. But here's the trap. Their combined income just jumped by $576 at 50% inclusion, pushing them deeper into the 85% taxation tier. Roughly $980 becomes taxable benefits. At a 22% tax bracket, that's $216 in new federal taxes. Plus, this income bump triggers Medicare IRMAA surcharges, another $180 to $240 annually. Net result, they keep maybe $756 of their $1,152 raise. That's a 34% effective tax rate on the COLA increase alone. And this scenario plays out for millions of retirees every January. That's $1,152 in new annual benefits, about $96 more per month. But here's the catch. Most of that raise gets taxed away or triggers Medicare surcharges. For someone in the higher tier, 85% of that increase becomes taxable income. Plus, it pushes your modified AGI higher, triggering IRMAA, Medicare's income-related premium adjustment. So while the Social Security Administration announces a $96 monthly increase, your take-home is closer to $14 per month after federal taxes and IRMAA kicks in. That's an effective tax rate of 85% on the COLA increase alone. It feels like something. It's not nothing. There's a shift happening. Subtle but real, not quite tangible yet unmistakable. The kind of realization that creeps in quietly. But recalculate combined income. That's the critical formula most people miss. Combined income equals AGI plus 50% of your Social Security benefits plus any tax-exempt interest. That one calculation determines whether you pay $0 in tax on your benefits, or whether up to 85% becomes taxable. This is why a retiree with $36,000 in Social Security and $60,000 in other income suddenly owes $6,358 in federal taxes. They didn't anticipate. The formula is simple. The impact is massive. $40,000 pension. This is often the first major income source retirees rely on. When Social Security arrives, it doesn't exist in isolation. It combines with your pension, investments, and other income in a formula the IRS calls combined income. This single calculation determines how much of your Social Security becomes taxable. And here's what shocks most retirees: up to 85% of your benefits can be taxed. The thresholds that determine this, they haven't moved since 1984, frozen for over 40 years while inflation pushed millions of retirees into higher tax brackets. Plus $7,576. That's half of the new $37,152 benefit. Here's what this means. The January 2026 COLA increase delivers $7,576 in additional annual Social Security income for this retiree. But here's the critical part most people miss. That $7,576 increase doesn't hit your bank account tax-free. Depending on your other income, up to 85% of this increase becomes taxable. For someone in the 22% tax bracket, that's roughly $5,600 in federal taxes on a $7,576 raise. Plus, this income boost triggers the Medicare IRMAA charge, adding another $1,000 to $1,500 in annual premiums. Your net benefit from the COLA? Sometimes just $1,000 to $2,000. The thresholds haven't changed since 1984, so inflation in the form of your COLA pushes you deeper into taxation every single year, plus $0 in tax-exempt interest. This component factors directly into your combined income calculation, which determines how much of your Social Security becomes taxable, equals $47,576. This is the total taxable Social Security benefits amount, calculated using the IRS Worksheet 3 formula we just walked through. For a married couple in the example scenario with $78,000 combined income and $36,000 in total Social Security benefits, approximately $28, $900 becomes taxable income. But in this moment, we're showing the cumulative impact, the actual dollar figure that the IRS will count as ordinary income on your tax return. At a 22% federal bracket, this translates to roughly $6.358 in federal income tax on Social Security benefits alone. This is the number that catches retirees by surprise every April. Their excess over the $32,000 threshold is now $15,576. This means their combined income has crossed well into the second taxation tier, where up to 85% of their Social Security benefits become taxable. The January 2026 COLA increase has pushed them deeper into this territory, magnifying the tax impact significantly. What's this fashion? 50% of that is $7,788, still under the $18,000 Tier 1 cap, so the taxable amount under Tier 1 is $7,788. Their excess over the $44,000 threshold is now $3,576. This crosses into Tier 2 taxation territory, where up to 85% of benefits become taxable income. 85% of that is $3,039. Let me show you what this number really means. Out of every Social Security check you receive, up to 85% can become taxable income. That's not a theoretical number, it's the maximum threshold set by Congress in 1984, and frozen ever since. So if your combined income crosses the Tier 2 threshold, 85% of your benefits get added to your taxable income. In this case, that's $2,583 in Social Security benefits. The IRS counts as your income. Most retirees never see this breakdown. Your bank shows the deposit. The IRS shows the tax bill. We're going to bridge that gap right now. Total taxable benefits: $10,827. This is the critical number that determines how much federal income tax you'll owe on your Social Security. For this retiree, it means roughly $2,382 in federal taxes at a 22% bracket, money that comes directly out of the retirement income they counted on. Federal tax at 22%, $2,382. This is the federal tax owed on taxable Social Security benefits when your combined income exceeds the threshold. Combined income equals your adjusted gross income plus 50% of Social Security benefits, plus tax-exempt interest. Once you cross $32,000 for married filing jointly, up to 85% of your benefits become taxable. These thresholds haven't changed since 1984. Inflation keeps pushing more retirees into taxation every year. The increase from 2025 to 2026, $23. That's the net benefit after taxes and Medicare surcharges hit. You got a raise. Inflation gave you $23 more per month. The government took the rest, so out of the $1,152 COLA increase, $23 went to federal taxes. That seems low, right? But this is where the trap reveals itself. That same $1,152 in combined income pushes you deeper into the Medicare IRMAA calculation. The federal tax is just the visible part. The Medicare surcharge is the hidden tax. Combined, your effective tax rate on this COLA increase is far higher than 2%. But that's not the whole picture. Scene 71 of 222, we're diving deep into how Social Security taxation actually works. The critical misconception most retirees have: they think Social Security is tax-free. It's not. Up to 85% of your benefits can be taxable income. And here's what shocks people: the taxation thresholds haven't been adjusted since 1984. That's 41 years of frozen brackets while inflation keeps pushing more retirees into taxable territory. This is the foundation you need to understand before we talk about the January 2026 COLA impact and the Medicare IRMAA trap. Let's break down the formula. The hidden second tax. Here's what shocked me. A retiree I know got a Social Security raise this month. It was supposed to help instead. It triggered $2,000 in new federal taxes and another $1,500 in Medicare surcharges. That's an 85% tax rate on the increase. And this happens to roughly 3 million retirees every January. Social Security isn't tax-free. Up to 85% of your benefits can be taxable income. The taxation thresholds haven't been adjusted since 1984, frozen for 41 years. Each January, inflation pushes more retirees into taxable brackets. The January 2026 COLA increase will trigger this for thousands of new retirees. Today, we're breaking down the 4 tax impacts your CPAs probably won't explain clearly. The combined income formula determines everything. It's AGI plus 50% of Social Security benefits plus tax-exempt interest. This single calculation controls whether you pay 0 tax or 85% taxation on your benefits. When you cross the $32,000 threshold for married couples or $25,000 for singles, the taxation begins. Most retirees have no idea these thresholds exist. Now this couple hits something they might not have anticipated. Medicare IRMAA Day. Their Social Security income, the same income that triggered federal taxation, also triggers Medicare premium surcharges based on something called income-related monthly adjustment amounts. It's a double tap. The same $80. The same $80. 000 in combined income that creates $4,840 in federal taxes on their benefits. Also pushes them into a higher Medicare premium tier, adding another $2,052 per year in Part B and Part D surcharges. That's $6,892 in total taxes and fees on income they thought was protected. And when their COLA increase hits in January, that $1,080 raise becomes taxed at an effective 85% rate, both federally and through Medicare. Most retirees have no idea these two systems are connected. IRMAA stands for Income-Related Monthly Adjustment Amount. It's a surcharge on your Medicare premiums based on income from 2 years prior. The calculation for IRMAA uses the same combined income formula as Social Security taxation. Both are calculated identically AGI plus 50% of Social Security benefits plus tax-exempt interest. This creates what we call a double trap for retirees. The same income threshold that triggers federal taxes on your Social Security benefits is also the threshold that triggers Medicare premium surcharges. So when your Social Security COLA increases push you over that threshold, you're hit twice, once by federal taxation, and again by IRMAA increases. This is why understanding the formula isn't just about taxes, it's about your total out-of-pocket cost in retirements. In 2024, their income was their pre-COLA amount. Their IRMAA for 2026 Medicare was already set, but in 2025, with the COLA increase, their combined income moved higher. That will affect their 2027 IRMAA BOA. For 2026 Medicare, based on 2024 income, they're in a specific bracket. Let's say they're paying a Part B premium of $18,750 per month, the standard rate, but as their income crossed $47,500 in 2025, they're now in a higher IRMAA bracket for 2027. When 2027 arrives, their Part B premium jumps to $24,980 per month. That's an increase of $6,230 per month, or $74,760 per year. And Part D prescription drug coverage has its own IRMAA surcharge that could add another $300,400 per year, from the COLA increase of $1,152. This is where most retirees get blindsided. That Social Security raise you're celebrating, up to 85% of it can be taxed away. Plus Medicare premiums jump. The combined impact? An effective 86% tax rate on the increase alone. Let me show you the math. $23 in federal income tax. That's what this retiree owes on Social Security benefits. Seems small, right? But here's what shocks most people, that $23 represents a portion of their Social Security check that the IRS considers taxable income. And for millions of retirees in 2026, this exact scenario plays out in ways they never anticipated. The thresholds that determine whether your Social Security gets taxed haven't changed since 1984. That's 41 years of frozen income limits, while inflation quietly pushes more and more retirees across the taxation line. Up to 85% of your Social Security benefits can become taxable income. This is the formula most CPAs don't explain clearly, and it's costing retirees thousands every year. $74,760 in higher Part B premiums. That's the Medicare IRMAA surcharge. the hidden tax that kicks in when your Social Security combined income crosses the threshold. For many retirees, the January COLA increase doesn't just get taxed at 85%. It also triggers this Medicare premium jump, so your raise becomes a pay cut. This is the second part of the double tap that catches retirees off guard. $350 in higher Part D premiums. Estimated, this is where the hidden cost reveals itself. Your Social Security COLA increase didn't just trigger federal income tax on your benefits. It also pushed your modified adjusted gross income, that's the same income calculation Medicare uses for IRMAA, into a higher premium bracket. Part D alone climbs by $350 annually. Combined with the federal tax impact and Part B surcharges, that January COLA you celebrated, much of it evaporates. This is the Medicare IRMAA trap, IRMAA trap, that catches retirees by surprise. Total $1,120.60. This is your combined taxable Social Security benefits figure, the amount the IRS uses to calculate your federal income tax obligation. Remember, up to 85% of your total benefits can be taxable income. At this benefit level, you're likely in Tier 1 or lower Tier 2 taxation. But here's the trap. This same $1,12060 rolls into your modified adjusted gross income for Medicare IRMAA calculations. That means a single IRS number triggers two separate tax bills: federal income tax on your benefits, plus potential Medicare premium surcharges for a retiree in the 22% bracket. This $1,12060 translates to roughly $246 in federal tax alone. Add IRMAA, and your true cost climbs to $400, $950 annually, depending on your total combined income. This is why understanding the mechanics matters. Small benefit numbers compound into large tax surprises. A couple received a $1,152 benefit increase and lost $1,12060 to taxes and Medicare surcharges. That's an effective tax rate of 85% on their raise. Federal income tax claims $600. Medicare IRMAA surcharges took another $52,060. Combined, they kept just $3,140 of the increase. This is the COLA trap. Inflation raises your benefits, but frozen tax thresholds from 1984 mean most of that raise gets taxed away. Their net gain, $31, after federal taxes on the benefits and the Medicare IRMAA surcharge triggered by that same income. The COLA increase, which was supposed to help, netted them only $31 for the entire year. Their effective tax rate on the COLA increase, 973%. That means out of every dollar they receive in their January raise, 97 cents goes directly to federal taxes and Medicare surcharges. Almost nothing reaches their wallet. The formula that determines your Social Security taxation is called combined income, and it's more complex than most retirees realize. Combined income equals your adjusted gross income, plus 50% of your Social Security benefits, plus any tax-exempt interest. This single calculation determines whether 0, 50%, or up to 85% of your benefits become taxable. The critical thresholds: $32,000 for married filing jointly, $25,000 for single filers, haven't changed since 1984. That's 42 years of frozen numbers, while inflation pushed millions of new retirees into unexpected taxation. When the January 2026 COLA increase arrives, well, you'll see exactly how this trap works. A $1,000 benefit increase that generates $850 in new taxable income, and that's before Medicare IRMAA kicks in, which uses the same combined income calculation to raise your premiums. Understanding this mechanic unlocks strategic options: Roth conversions before claiming, income timing, claiming age optimization that can save tens of thousands over retirements. When you cross the line, the Social Security taxation thresholds have been frozen since 1984. That's 41 years of inflation pushing more retirees into taxable brackets. Up to 85% of your benefits can become taxable income. The January COLA increase doesn't help. Triggers unexpected federal taxes and Medicare surcharges. This is the hidden tax most CPAs won't explain. Understanding when you cross the line changes everything about your retirement plan. Now let's zoom into what happens when someone crosses the threshold for the first time. Single retiree, age 67. Social Security benefits received this month triggered unexpected federal taxation and Medicare surcharge increases. The COLA raise, meant to help offset inflation, instead created a hidden tax burden. Up to 85% of benefits become taxable income when income crosses certain thresholds. These thresholds have been frozen since 1984, unadjusted for inflation. Each January, thousands more retirees cross into taxable territory automatically. The Medicare IRMAA system amplifies the impact, using the same income calculation together. These create a compound double-tap effect that catches retirees off guard. Strategic planning, Roth conversions, income timing, claiming age optimization can save tens of thousands over retirement. Understanding the mechanics empowers smarter financial decisions. For 2025, their income situation was pension $60,000, investment income $18,000, Social Security $36,000, combined total $114,000, interest and dividends $24,500. This is the investment income threshold that, when combined with Social Security benefits and other income sources, triggers the taxable benefits formula for a single filer. This amount alone pushes combined income over the $25,000 Tier 1 threshold, meaning up to 50% of your Social Security benefits become taxable. Add a modest Social Security benefit to this figure and you're immediately in Tier 2 territory, where up to 85% of benefits can be taxed. This is precisely the income level that the January 2026 COLA increase will push thousands of retirees across, creating an unexpected tax bill on an income boost they thought would help their retirements. Rental income from property $5,500. This income is critical because it flows directly into your combined income calculation. Every dollar of rental income, including depreciation recapture, counts toward the $32,000 Tier 1 threshold or the $44,000 Tier 2 threshold for married filing jointly. If you're a single filer, this $5,500 moves you closer to the $25,000 threshold. The trap rental income doesn't feel like regular income, so retirees often overlook it when estimating their Social Security taxation, but the IRS counts it, and when combined with 50% of your Social Security benefits plus any tax-exempt interest, this $5,500 could push your entire benefit package into the 85% taxation zone. That's the critical detail most tax creators skip. Social Security $36,000. This is the annual benefit amount we're examining. But here's the critical detail most retirees miss. Up to 85% of your Social Security benefits can be taxable income under IRC Section 86. The taxation thresholds $25,000 for single filers, $32,000 for married filing jointly, haven't been adjusted since 1984. That's 42 years of frozen brackets, while inflation has relentlessly pushed more and more retirees into taxable territory. This $36,000 benefit, when combined with other income through the combined income formula, often triggers substantial federal taxation, and that's before Medicare IRMAA surcharges kick in. Combined income $24,500 plus $0. No Social Security yet. Plus $5,500, plus $18,000, which is half of Social Security benefits, equals $48,000. This combined income calculation determines how much of your Social Security becomes taxable at $48,000. You've crossed into Tier 2 taxation territory. Up to 85% of your benefits can now be subject to federal income tax. The thresholds that trigger this taxation: $32,000 for married filing jointly, $25,000 for single filers, haven't been adjusted since 1984. That's 41 years of frozen brackets, while inflation pushes more retirees into taxable territory every January with each COLA increase. They've been in the higher tax bracket already. This isn't new to them, but now imagine a different person with the same Social Security benefit who defers claiming until 2026. For 2025 and beyond, here's the critical truth about Social Security taxation that catches retirees off guard. Couple receives a Social Security cost of living adjustment supposed to help instead. It triggers $2,000 in new federal taxes and another $1,500 in Medicare surcharges. That's an 85% effective tax rate on the increase alone. This happens to roughly 3 million retirees every January because the taxation thresholds have been frozen since 1984, frozen for 41 years while inflation marches forward. Today we're breaking down the 4 major angles: how Social Security taxation actually works using the combined income formula from IRS Publication 590A, the January 2026 COLA impact with real numbers, showing which retirees get pushed into taxable brackets, the hidden Medicare IRMAA trap where the same income calculation triggers higher premiums, and strategic planning opportunities, Roth conversions, income timing, claiming age optimization, that can save you $26,000 or more over a decade. Most CPAs won't explain the mechanics clearly because they're complex, but understanding the frozen $32,000 threshold for married filers, the 2-tier taxation system reaching 85%, and how a $1,000 raise becomes nearly zero after taxes, this changes your retirement plan. Let's walk through the actual calculations, real scenarios, and actionable strategies. Interest and dividends. $24,500. This is the investment income component that gets added directly into your combined income formula. Every dollar counts toward triggering Social Security taxation for a single filer. This $24,500 alone exceeds the $25,000 Tier 1 threshold by just $500, meaning if you also receive Social Security benefits, you're already crossing into taxable territory. Rental income $5. $500. This is one of the income sources that gets added into your combined income calculation, the formula that determines how much of your Social Security becomes taxable. Many retirees don't realize rental income counts here. It pushes you closer to those frozen thresholds. For a single filer, just $5. $500 in rental income moves your combined income significantly. Combined with Social Security and other sources, it can trigger Tier 1 taxation at $25,000 or push you into Tier 2 at $34,000. This $5,500 might seem modest, but in the taxation formula, it's one of the pieces that costs you. Social Security $0. Not yet claimed. This is the starting point. No benefits flowing in yet, but the taxation clock is ticking. Once you claim, the combined income calculation begins immediately. Understanding when and how much to claim is the foundation of everything that follows in your retirement tax strategy. Combined income $30,000. This is the critical figure that determines how much of your Social Security benefits become taxable income under IRC Section 86. Combined income includes your adjusted gross income, plus 50% of your Social Security benefits, plus any tax-exempt interest at $30,000. A single filer is above the $25,000 Tier 1 threshold, meaning benefits will be partially taxable for a married couple filing jointly. This amount is well below the $32,000 Tier 1 threshold, so no taxation would apply. This single calculation triggers cascading effects, federal income tax on benefits, Medicare IRMAA surcharges, and determines your tax planning strategy for the entire year. This person is still below or at the $32,000 threshold. Their Social Security isn't taxable yet. In 2026, they claim benefits. The new benefit is $37,152 with COLA cost of living adjustment. This increase, while welcome, pushes many retirees into higher taxation brackets because the IRS thresholds haven't been adjusted since 1984. The combined income formula determines your Social Security taxation at 50% or 85%. The thresholds, frozen since 1984 at $32,000 for married filers and $25,000 for single, haven't adjusted for inflation once in 41 years. This January 2026, when the COLA increase arrives, millions of retirees will automatically move into higher tax brackets. Here's the shocking part: up to 85% of your Social Security raise gets taxed away by federal income tax plus Medicare IRMAA surcharges. This hidden trap catches retirees off guard every single year. Interest and dividends, $24,500. This is the income threshold that triggers Social Security taxation for many retirees. When combined with 50% of your Social Security benefits, it determines your total combined income for single filers. This amount alone exceeds the $25,000 Tier 1 threshold, pushing benefits into taxable territory. For married couples, it contributes significantly toward the $32,000 threshold, frozen since 1984. This investment income, combined with any pensions or other AGIYE, creates the perfect storm. Inflation pushes more retirees over the line every January. Rental income $5,500 per year. This amount adds directly to your combined income calculation for Social Security taxation purposes, potentially pushing you into higher tax brackets or triggering Medicare IRMAA surcharges. Social Security $37,152. This is the annual benefit amount that will trigger significant taxation under IRC Section 86, depending on your combined income and filing status. Combined income $24,500 plus $5,500 plus $18,576. That's half of your Social Security benefits equals $48,576. This combined income figure is the critical calculation the IRS uses to determine how much of your Social Security is taxable under IRC Section 86. At this income level, you're well into the Tier 2 taxation zone, meaning up to 85% of your benefits can be subject to federal income tax. They cross the threshold. Now $17,288 of their Social Security becomes taxable. This is the moment when combined income exceeds the Tier 2 threshold of $44,000 for married filers. At this point, Up to 85% of benefits transition into taxable income. For this couple, it means their Social Security COLA increase meant to help instead triggers federal taxes and Medicare IRMAA surcharges totaling nearly $3,000 annually. The thresholds haven't moved since 1984. Inflation has. That's the trap. At 22%, that's $3,803 in federal tax, on $17,300 in benefits. That's the Tier 2 calculation. 85% of your excess income becomes taxable. This is why COLA backfires. They cross the threshold due to COLA, not due to any change in their own income inflation, in the form of that Social Security cost of living adjustment, automatically pushed them into a higher tax bracket. Their pension didn't increase, their investment income didn't increase, but the government's Social Security payment to them did. And because of those frozen thresholds from 1984, that increase went straight into their combined income calculation. The result? An 85% effective tax rate on the COLA increase alone. They got a raise they didn't earn, and it cost them thousands in new taxes. Understanding Social Security taxation with frozen thresholds since 1984, up to 85% of your benefits can be taxable. The January 2026 COLA increase triggers unexpected tax liability for millions of retirees. Your raise becomes a tax bill. The frozen moment in time, when Social Security COLA increases trigger unexpected tax bills. Thousands of retirees discover their raises get taxed at 85%. January 2026 changes everything. Understanding the mechanics changes your retirement plan. This is the core mechanism. Understanding how it works unlocks strategic planning opportunities for retirees. The frozen thresholds, combined income formula, and two-tier taxation system are the foundation. Master this mechanism. In 1984, Congress set the combined income thresholds for Social Security taxation at $32,000 married and $25,000 single. Since then, those numbers have been adjusted exactly 0 times. These tax thresholds, the $32,000 threshold for married couples and $25,000 for single filers, were set by Congress in 1984 and have remained frozen ever since. While inflation has eroded the purchasing power of those dollars by over 60%, the thresholds haven't budged. That means every year, more retirees cross into taxable territory automatically, purely because inflation pushed their combined income over the line. It's not a policy change. It's not a deliberate tax increase. It's statutory negligence, a rule nobody touches because fixing it requires Congress to act. 0. That's what your Social Security COLA increase is really worth after taxes and Medicare premiums. Not 1 cent, not a penny. Your raise just vanished. Inflation taxed it away at 85%. This is the trap most retirees never see coming. Social Security benefits increased, inflation increased, wages increased, but the threshold stayed frozen. Since 1984, 41 years of no adjustment means more and more retirees are getting pushed into taxation brackets. They didn't expect that frozen threshold is the hidden tax trap. In 1984, $32,000 was a substantial middle-class income. Most retirees wouldn't hit that threshold. Today, it's the frozen tax line that determines how much of your Social Security gets taxed. By 2026, $32,000 is barely above minimum wage work. The average middle-class retiree with a pension, some investments, and Social Security easily exceeds it. In 1984, about 10% of Social Security recipients had any taxable benefits at all. Now it's over 50%. By 2023, 50% of Social Security recipients paid taxes on their benefits. That's roughly 20 million retirees affected. The taxation thresholds haven't adjusted since 1984, frozen for over 40 years. Inflation keeps pushing more people into taxable brackets every single year. By 2026, with another COLA and no threshold adjustment, that's approaching 52%. Every single year, the COLA pushes more people past the threshold. Every single year, taxation creeps higher. Understanding Social Security taxation when COLA increases hit in January 2026. Up to 85% of your benefits can be taxable. The thresholds haven't changed since 1984. Inflation keeps pushing more retirees over the edge. Your raise may trigger $2,000 or more in new taxes. Today, we're breaking down the 4 hidden impacts that your CPA probably won't explain clearly. The real household math. Here's what shocked me. A retiree got a Social Security raise this month. It was supposed to help instead. It triggered $2,000 in new federal taxes and another $1,500 in Medicare surcharges. That's an 85% tax rate on the increase. And this happens to roughly 3 million retirees every January today. We're we're breaking down the 4 tax impacts your CPAs probably won't explain clearly. Most retirees think Social Security is tax-free. It's not. Up to 85% of your benefits can be taxable income. The taxation thresholds haven't been adjusted since 1984, frozen for 41 years. Each year, inflation pushes more retirees into taxable brackets.
Here's what shocked me. A retiree I know got a Social Security raise this month. It was supposed to help. Instead, it triggered $2,000 in new federal taxes and another $1,500 in Medicare surcharges. That's an 85% tax rate on the increase, and this happens to roughly 3 million retirees every January. Today, we're breaking down the 4 tax impacts your CPAs probably won't explain clearly. Most retirees think Social Security is tax-free. It's not. Up to 85% of your benefits can become taxable income due to something called combined income, a formula that includes your AGI plus 50% of your Social Security benefits. The taxation thresholds for this calculation were set by Congress in 1984 at $32,000 for married couples and $25,000 for singles. They have not been adjusted for inflation once in 41 years. This creates what economists call bracket creep for retirees. Every year, inflation pushes more people into taxable territory through no action of their own. When you add the January 2026 COLA increase, which the Social Security Administration announced in October 2025, thousands of new retirees will cross these thresholds for the first time. But here's the trap: nobody mentions that same income calculation triggers Medicare IRMAA surcharges. So your Social Security raise doesn't just get taxed, it also increases your Medicare premiums. Combined, you could face an 85% effective tax rate on your COLA increase alone. In this video, I'm going to walk you through exactly how this works, show you 3 real scenarios of couples getting pushed into taxation, and give you 4 strategic planning moves that can save you tens of thousands over retirement. Let's start with the formula.
Couple, both age 70. Both claimed Social Security in prior years. Now they're facing a taxation surprise from frozen 1984 thresholds. The COLA increase triggers additional Medicare IRMAA. Upcoming strategic planning decisions matter now. Their monthly Social Security combined $3,100. That's $37,200 per year. Now the combined income formula determines how much of those benefits become taxable. For a married couple, the calculation is straightforward. Their adjusted gross income plus 50% of their Social Security benefits plus any tax-exempt interest. This combined figure is what triggers the taxation thresholds that have been frozen since 1984. That's $37,200 annually. Your Social Security income for the year. Pension income from both prior employers, $48,000 annually. This is a substantial and stable retirement income stream that directly feeds into your combined income calculation for Social Security taxation purposes. Investment portfolio generating interest and dividends, $12,000 annually. This passive income stream contributes directly to your combined income calculation for Social Security taxation purposes, pushing you closer to those frozen threshold. They have no rental properties, no significant other income. This couple relies entirely on Social Security benefits, with no diversified income streams to offset taxation. Calculate combined income. This is the critical formula that determines how much of your Social Security benefits become taxable. It's AGI, your adjusted gross income, plus 50% of your Social Security benefits become taxable, plus any tax-exempt interest you received. This combined income number gets compared to 2 frozen thresholds set back in 1984. For married filing jointly, that's $32,000 for Tier 1 and $44,000 for Tier 2. For single filers for $25,000 and $34,000. Here's the problem: those thresholds haven't moved in 41 years. Inflation has forced so every January when Social Security gets a cost of living adjustment, your combined income goes up, and when it goes up, you cross into higher taxation tiers. This is how retirees end up paying an 85% effective tax rate on their raise. Breaking down your real retirement income: $48,000 from pensions, plus $12,000 from investments, plus $18,600 from half of $37,200 in Social Security benefits, equals $78,600 in combined income. Here's the shock: at this combined income level, up to 85% of your Social Security can become taxable. Why? Because the IRS thresholds, $32,000 for married filing jointly, have been frozen since 1984, 41 years. No inflation adjustment, which means every year inflation pushes more retirees into higher taxation brackets automatically. In Tier 1, 50% of that excess is potentially taxable, $23,300. But the cap is 50% of total benefits, equals $18,600. So Tier 1 captures the full $18,600. so Tier 1 captures the full $18,600. In Tier 2, the excess over $44,000 is $34,600. 85% of that is $29,410. We already counted $18,600 in Tier 1, so the Tier 2 amount taxable is $10,810. We already counted $18,600 in Tier 1, so the Tier 2 amount taxable is $10,810. We already counted $18,600 in Tier 1, so the Tier 2 amount taxable is $10,810. We already counted $18,600 in Tier 1, so the Tier 2 amount taxable is $10,810. We already counted $18,600 in Tier 1, so the Tier 2 amount taxable is $10,800. Total taxable Social Security $29,410, or about 79% of their entire benefit. This couple has pushed deep into Tier 2 taxation, where the IRS captures nearly all of their Social Security income, at a 22% federal tax bracket, $6,470 in federal tax. But federal tax is not the only reality. They'll also owe 124% of their self-employment income, if any. This is the combined Social Security and Medicare tax rate. Self-employed workers pay both the employee and employer portion. In addition to federal taxation, state income tax on Social Security benefits varies dramatically by state. Depending on where you retire, your state could tax anywhere from 0 to 40% of your benefits. For this income level, state taxes could range from $2,000 to $4,000 annually. That's on top of the federal tax and Medicare IRMAA surcharges we've already covered. This is the third tax layer most retirees never anticipated. Here's the trap nobody warns you about. Your Social Security just went up. But Medicare saw that increase, and now you're paying $125 to $150 more per month in premiums. That's called an IRMAA surcharge, income-related monthly adjustment amount. It's triggered by the exact same income calculation that taxes your Social Security benefits. So that raise? Much of it goes straight to Medicare. For this household, the true all-in tax rate on their $37,200 Social Security benefit is approximately 2,832%. This means that nearly one-third of every benefit dollar is consumed by federal income taxes and Medicare IRMAA surcharges combined, a hidden cost most retirees never anticipate. They're not keeping $37,200. They're keeping roughly $25,000 to $26,000. Taxes and surcharges take the rest. Scene 152. Mark discovers the shocking reality of Social Security taxation. His combined income of $78,000 triggers the two-tier system, making $8,025% of his $36,000 annual benefits taxable. The calculation is clear. $28,900 in taxable Social Security benefits means $6,358 in federal taxes. He never anticipated. The frozen thresholds, unchanged since 1984, have silently pushed millions of retirees into a taxation bracket they didn't know existed. Mark's $36,000 in Social Security benefits, combined with his $60,000 in other income, reveals the hidden tax burden that catches most retirees completely off guard. Why does the system stay this way? The Social Security taxation thresholds were frozen in 1984. That's 41 years ago. Congress set the Tier 1 threshold at $32,000 for married filers and $25,000 for single filers. They set the Tier 2 threshold at $44,000 and $34,000. Then they never adjusted them, not once, not for inflation, not for anything. Meanwhile, inflation has compounded year after year. What was a comfortable income in 1984 is poverty level today, but the thresholds don't move. So every January, when Social Security recipients get their COLA increase, more of them cross into taxable territory. It's not by choice. It's not because they earned more or planned poorly. It's because the law froze 41 years ago. Congress could fix this. They could index the thresholds to inflation like they do with the standard deduction. But they haven't. Political gridlock, competing priorities, budget concerns. Whatever the reason, retirees are caught in the middle. The system wasn't designed for a 41-year freeze. It's broken. And every year it costs you more. The frozen thresholds aren't an accident. Their statutory Congress wrote them into the tax code in 1984 and chose not to adjust them. Why? That's the question every retiree asks when their Social Security COLA increase gets swallowed by taxes and Medicare surcharges. The answer is hidden in a frozen tax formula from 1984 that Congress never adjusted for inflation. Combined income, AGI plus 50% of your Social Security benefits, triggers two taxation tiers. Tier 1 taxes 50% of the excess over $32,000. Tier 2 taxes 85% of the excess over $44,000. And that's before Medicare's IRMAA surcharge uses the same calculation to raise your premiums. Why? Because the system wasn't designed for retirees. It was designed in an era when few retirees had enough income to trigger taxation. Today, inflation pushes more than half of all Social Security recipients into taxable brackets every single year. Political incentive. Adjusting the thresholds would reduce tax revenue. It would be called a tax cut for retirees. No administration wants to claim credit for that when they're running deficits. It's easier to let inflation do the work. Year by year, more people cross the threshold. Year by year, more retirees pay unexpected taxes, and most of them don't connect the two events. They think they're just unlucky. They're not. They're experiencing a systematic, deliberate fiscal mechanism. Systematic, deliberate fiscal mechanism. Most retirees think Social Security is tax-free. It's not. Up to 85% of your benefits can become taxable income. The IRS uses something called combined income to determine this. That's your adjusted gross income, plus 50% of your Social Security benefits, plus any tax-exempt interest. Here's the problem. The taxation thresholds have been frozen since 1984. For a married couple filing jointly, it's still just $32,000. For singles, $25,000. Inflation hasn't stopped, but these thresholds have when Social Security increases by the cost of living adjustment, more retirees cross into taxable territory. And that's not the only trap. The same income calculation that determines Social Security taxation also triggers Medicare IRMAA surcharges. Higher premiums for people with higher incomes. This video breaks down all four angles of Social Security taxation, with real numbers and strategic planning opportunity. The paradox here is what nobody tells you about Social Security. You get a cost of living adjustment, a raise in January. Sounds good, right? Wrong, that raise doesn't stay in your pocket. It becomes taxable income. The IRS thresholds that determine whether your benefits get taxed were frozen in 1984, frozen for 42 years. Inflation has been pushing more and more retirees over those thresholds. So your COLA increase, your benefit immediately triggers taxation, and not just federal income tax. Medicare premiums go up too through IRMAA, the income-related monthly adjustment amount. Both calculations use the same formula. Your Social Security raise cascades into an 85% effective tax rate. 3 million retirees cross into taxation every January because of this paradox. You got a raise. The government got more. Unless you understand the mechanics and plan ahead, you're playing a rigged game. Here's the paradox that shocks most retirees. You get a Social Security raise in January, a cost of living adjustment, or COLA. It's supposed to help you keep pace with inflation. Instead, that raise triggers taxes you didn't anticipate. In fact, for many retirees, up to 85% of those benefits become taxable income. And this January 2026, when Social Security increases by roughly 2 to 3%, approximately 3 million more retirees will cross into taxable territory for the first time. The culprit? Tax thresholds that Congress froze in 1984, 41 years ago. They've never been adjusted for inflation. Not once. This creates what economists call bracket creep. But for Social Security, it's benefit taxation creep. And it gets worse. That same calculation triggers Medicare IRMAA surcharges, additional premiums stacked on top. So a couple receiving $1,000 in COLA might see $850 disappear to federal taxes and Medicare increases. That's an effective 85% tax rate on the raise itself. Today we're breaking down the 4 tax impacts. Your CPA probably won't explain clearly how Social Security taxation actually works. The January 2026 COLA impact with real numbers, the hidden Medicare IRMAA trap, and the strategic planning opportunities that can cut your tax bill by thousands per year. You can receive a benefit increase from Social Security and experience a net decrease in cash flow. Here's the trap: that January COLA increase goes directly into your combined income calculation, which triggers 2 simultaneous tax events. First, up to 85% of the increase becomes taxable federal income at your marginal rate. That's roughly 22% to 37% in federal tax alone. Second, that same income increase pushes you into higher Medicare IRMAA brackets, adding $125 to $375 per month in premium surcharges. Combined, an extra $1,000 in Social Security can cost you $850 in taxes and Medicare increases. You got a raise, you're actually going backward. This is the hidden mechanics most retirees never understand until tax season arrives. That's the reality for millions of retirees in January 2026. The COLA was supposed to help offset inflation for many retirees. The tax and IRMAA impact will exceed the COLA itself. They got a raise. Their real spending power went down. This is the January 2026 Social Security COLA trap. A retiree receives a $1,080 increase in annual benefits from the cost of living adjustment. Sounds great. But here's what happens. That $1,080 gets added to their combined income calculation. Because of the frozen tax thresholds from 1984, the IRS now taxes 85 cents of every new dollar in benefits. The $1,080 raise becomes just $162 after federal taxes. But wait, there's more. That higher income also triggers Medicare IRMAA surcharges, adding another $918 in premium increases. The real result, a $1,080 raise becomes a net $28 increase in actual spending power, an 85% effective tax rate on the increase alone, and this happens to roughly 3 million retirees every January. This is the hidden cost nobody explains, understanding how Social Security taxation actually works in 2026, and the COLA trap that catches millions of retirees by surprise. Here's what most retirees don't realize: up to 85% of your Social Security benefits can be taxable income. The taxation thresholds haven't been adjusted since 1984. That's 42 years of frozen brackets, while inflation pushes more and more retirees into taxable territory. In January 2026, when that COLA increase hits, thousands of new retirees will cross into taxation for the first time. And here's the kicker. Many of them will see an effective tax rate of 85% on that raise. We're breaking down the formula, showing real numbers, and revealing the Medicare IRMAA budged trap that doubles down on this taxation. By the end, you'll understand exactly why your Social Security increase might cost you thousands in new taxes. Who actually avoids this? The frozen threshold trap. Since 1984, these income limits haven't budged. Not once. Inflation keeps climbing. Your Social Security keeps rising. But the thresholds? Frozen. Which means more of your benefits get taxed every single year. It's not a mistake. It's the law. Not everyone is trapped. Some retirees have strategic options to minimize the impact. Understanding the rules is the first step to keeping more of your benefits. Retirees with income below $25,000, single or $32,000, married still have zero taxable Social Security. They're safe until their other income grows or Social Security increases further. Couples where one spouse doesn't claim Social Security until much later can time their claims to manage combined income. This strategic approach allows you to control when aggregate income triggers higher taxation brackets, potentially reducing federal taxes and Medicare IRMAA surcharges significantly over retirement. People with significant capital losses can offset investment gains and reduce their combined income. This is one of the most powerful tax strategies for retirees managing Social Security taxation. By harvesting losses strategically, you lower your AGI, which directly reduces your combined income calculation, moving you away from the 85% taxation tier. Let's show how this works in real numbers. High-income earners who can absorb the tax hit and don't need the Social Security benefits psychologically aren't shocked. They expected taxation. Couples living in states with no income tax reduce their overall burden. By strategically relocating or planning retirement in states like Florida, Texas, or Nevada, which have zero state income tax, retirees can keep more of their Social Security benefits, pensions, and investment income. While federal Social Security taxation still applies under IRC Section 86, eliminating state income tax creates significant cumulative savings, especially for couples in higher tax brackets or with substantial combined income, and people who understand the formula and work with a tax strategist can minimize it through Roth conversions, charitable distributions, or income timing. But the median retiree? They don't fall into any of these categories. They have a modest pension, some investments in Social Security. They cross the threshold. They get taxed, and they didn't see it coming. Scene 176. The hidden tax trap. Nobody sees your Social Security raise just got taxed away at 85%. Here's why January 2026 changes everything. 3 million retirees will be caught off guard by the COLA increase, triggering both federal taxation and Medicare IRMAA surcharges simultaneously. Double tap on retirement income that most financial advisors never fully explain, the escalation where it leads. When Social Security thresholds freeze for 41 years while inflation marches forward, the mathematics become inevitable. A retiree receives what feels like a raise, the January 2026 COLA increase. But combined income, that critical formula combining AGI plus 50% of benefits plus tax-exempt interest, now pushes them deeper into taxation territory. What was 50% taxable becomes 85% taxable. The 3 million newly affected retirees don't realize that 85 cents of every dollar gained vanishes into federal tax and Medicare IRMAA surcharges. This is not accident. This is statutory architecture. The thresholds $32,000 for married filing jointly, $25,000 for single filers were set by Congress in 1984. They adjust for inflation exactly 0 times since then. Each year, inflation does the work Congress refused to do. Each January COLA announcement, more retirees cross invisible lines. The escalation is mathematical. It is relentless. It is the reason strategic planning before claiming becomes essential. Zoom out, the threshold was set 42 years ago. Inflation has compounded roughly 320% since 1984. But the Social Security taxation thresholds? Frozen. That $32,000 limit for married couples filing jointly? Set in 1984. Never adjusted. Never moved. While everything else got more expensive, those thresholds stayed exactly the same. That's the core problem. Every year, inflation pushes more retirees into higher taxation brackets automatically, even though they didn't earn a dime more. The threshold should be approximately $102,400 if it had adjusted for inflation. That's what the combined income threshold for married filers would be in 2026 dollars. If Congress had indexed it to inflation since 1984, instead, it's still $44,000. That 42-year freeze means millions of retirees who think they're safely below the tax line are actually getting pushed into taxation by inflation alone, not by any choice of their own. Instead, it's still $32,000. The combined income threshold for married filing jointly filers remains frozen at $32,000. $32,000. This threshold has not been adjusted for inflation since 1984. That's 41 years of bracket creep. Every year, inflation pushes more retirees into taxable territory, even when their actual purchasing power hasn't changed. As each year passes and COLA increases compound, more retirees fall into the taxation trap. The thresholds, frozen since 1984, don't adjust for inflation, so every January, thousands of retirees receive a benefit increase, only to discover their taxes jumped even higher. It's bracket creep in slow motion. The IRS doesn't announce this clearly. The Social Security Administration doesn't explain that COLA will trigger taxes. Your 1099-R form will show the taxable amount, but you won't understand why until you read IRS Publication 590A. Publication. By then you owe the taxes. This is the moment when the frozen thresholds, unchanged since 1984, finally catch up with your retirement income. Your Social Security cost of living adjustment triggered it. The calculation was inevitable. Up to 85% of that benefit increase becomes taxable income. This is the hidden cost nobody mentions. What happens in 2027? Another COLA. Another threshold crossing. Another tax surprise. Inflation raises your Social Security benefits, but the tax thresholds? Frozen since 1984. So each January, millions of retirees get a raise. They never keep the COLA increase flows straight into combined income. Combined income triggers taxation. Taxation triggers Medicare surcharges. By the time you realize what happened, an 85% marginal tax rate has already eaten your increase. This is the hidden January trap that catches 3 million retirees off guard, year after year. This system is designed to be opaque, meaning it hides how it works. You don't see the formula. You don't see the calculation. The taxation thresholds stay frozen since 1984, with no updates. Inflation pushes you into higher brackets without transparency. That's the core problem, opacity. A PHSUT creates confusion, and confusion costs retirees thousands in unexpected taxes every single year. Most retirees will never fully understand that their Social Security taxation is pegged to a 1984 formula. The COLA trap, your raise just got taxed at 85%. Here's how inflation pushes retirees into hidden taxation. The Social Security thresholds haven't moved since 1984. That frozen line is costing millions of retirees thousands of dollars every January. Today, we're breaking down the 4 tax impacts your CPA probably won't explain clearly. What changes everything? The realization that Social Security taxation isn't just a tax, it's a trap that catches 3 million retirees every January when the COLA ICO increase hits. The thresholds frozen since 1984 mean inflation automatically pushes you deeper into taxation brackets. Your raise becomes a tax liability. But understanding the combined income formula, the two-tier system, and the Medicare IRMAA connection gives you strategic options most retirees never discover. This is the moment where knowledge transforms your retirement outcome. Understanding the formula changes the frame entirely. This is the critical calculation most tax creators skip over, but it's what determines taxation. The combined income formula, your AGI plus 50% of Social Security benefits plus tax-exempt interest, is where the complexity lives. When you grasp this formula, you realize why a COLA increase doesn't feel like a raise. It becomes taxable income immediately, pushing you deeper into the two-tier system, and those thresholds. Frozen since 1984. Inflation has done the rest. You stop seeing Social Security taxation as random misfortune. It's a predictable system with frozen thresholds since 1984. Inflation pushes you into higher tax brackets automatically. But here's what changes everything once you understand the combined income formula, the two-tier taxation structure, and how your COLA increase triggers Medicare surcharges. You realize this isn't random. It's mechanical. It's avoidable. You can time your Roth conversions, manage your AGI, optimize your claiming age. The system has rules. Learn them, and you reclaim control of your retirement income. You see it as a mechanical consequence of frozen thresholds meeting inflation. Mechanical consequence. The $32,000 taxation threshold for married couples hasn't moved since 1984. Inflation has every January. Social Security COLA increases push more retirees across that threshold, not because they earned more, but because Congress froze the numbers 41 years ago. This is taxation creep by design. You understand that the $1,100 COLA increase is not really a $1,100 increase for you. It's closer to $30,100 depending on your tax bracket and IRMAA situation. You realize that claiming Social Security at different ages has tax consequences that brokers don't mention. Most retirees think Social Security is tax-free. It's not up to 85% of your benefits can be taxable income. The taxation thresholds haven't been adjusted since 1984, frozen for over 40 years. Each year, inflation pushes more retirees into taxable brackets. Your January COLA increase? Much of it gets taxed away. Your financial advisor probably didn't mention this. You see that managing your other income in the years you claim is a legitimate tax strategy. By strategically timing when you receive pensions, investment income, or rental earnings, you can keep your combined income below the $32,000 threshold, meaning zero Social Security taxation on your benefits. This isn't aggressive, it's IRS-sanctioned planning. You understand why a retiree with a pension might delay Social Security to age 70. Not for the higher benefit alone, but to have years of lower combined income, where Roth conversions don't trigger surprise taxation. The math becomes a tool, not a surprise. Understanding the formula empowers your planning. Scene 198. The critical insight that ties everything together. Your Social Security benefits aren't actually tax-free. Up to 85% of them can be taxable income under Internal Revenue Code Section 86. Here's what shocks most retirees. The taxation thresholds that determine this: $000 for married couples, $25,000 for single filers, haven't been adjusted since 1984. That's 42 years of frozen numbers, while inflation compounds every single year. So when January 2026 rolls around and Social Security announces the COLA increase, that raise doesn't feel like a raise for millions of retirees. It's the exact trigger that pushes them from not taxable into the 50% tier, or from 50% tier straight into the brutal 85% tier. We're talking about an effective tax rate where you receive $1,000 in COLA benefits, and after federal taxes and Medicare IRMAA surcharges, you net maybe $150. That's an 85% marginal tax on the increase. This is the mechanics most tax creators skip, but it's exactly why understanding the combined income formula, AGI plus 50% of your Social Security benefits plus tax-exempt interest, is the foundation of every retirement tax strategy. Well, cover, your Social Security raise just got taxed away. Here's what's happening. A retiree I know received a COLA increase this month. It was supposed to help instead. It triggered $2,000 in new federal taxes and another $1,500 in Medicare surcharges. That's an 85% tax rate on the increase alone. This January, roughly 3 million retirees will face this same shock. Today, we're breaking down the 4 tax impacts your CPA probably won't explain clearly: the frozen threshold since 1984, the January 2026 COLA trap, the hidden Medicare IRMAA surcharge, and the strategic planning moves that actually work. Here's what to do immediately. Understand the combined income formula. That's AGI plus 50% of your Social Security benefits plus tax-exempt interest. Verify your 2026 COLA impact using the 3 scenarios we covered: the couple just under the radar, the couple crossing Tier 1 for the first time, and the surprise retiree. Calculate your IRMAA trigger. Remember, it uses the same modified AGI calculation, so your Social Security taxation directly drives your Medicare premiums. And explore the Roth conversion window before you claim. Convert traditional IRA funds while your income is lower, before Social Security kicks in. This can save you $26,400 over 10 years. Download the combined income calculator from the description, plug in your numbers, see your actual taxable benefits and estimated federal tax, then consult a CPA or tax professional to implement the strategy that fits your situation. Don't let inflation push you into the 85% taxation zone by accident. Get your most recent Social Security statement, or check your 1099-R from last year. Write down your Social Security benefit amount. You'll need this for the combined income calculation. Write down your adjusted gross income from your tax return. Pensions, interest, investments, rental income, everything. This is the foundation of the combined income formula that determines how much of your Social Security becomes taxables. Add half your Social Security to your AGI. This combined income figure is the critical calculation that determines how much of your benefits become taxable. It's the formula the IRS uses in Publication 590A. Worksheet 3, that's your combined income. Your AGI plus 50% of your Social Security benefits plus any tax-exempt interest. This is the number the IRS uses to determine how much of your benefits become taxable income. It's frozen thresholds from 1984 meeting inflation in 2026. And it changes everything. If it exceeds $32,000 married or $25,000 single, you're in the taxation zone. Now estimate your 2026 benefit with the COLA increase. Add that to your current AGI to see how much higher your taxation goes. Download the calculator in the description. It will run both scenarios and show you the exact tax impact. You're not looking for a way to avoid this legal obligation. You're looking to understand what's actually happening so you can plan around it. Some of you will shift your claiming age. Some will do Roth conversions before claiming. Some will manage investment income timing. You can optimize what you don't see. This is the core principle of financial strategy. Most retirees receive Social Security benefits without understanding how they're taxed. They don't see the frozen thresholds from 1984. They don't see the combined income formula. They don't see the Medicare IRMAA trap that amplifies the tax impact. And they don't see the strategic opportunities waiting in the tax code. When you make these hidden mechanisms visible, when you see the actual numbers, the actual formulas, the actual tax consequences, that's when optimization becomes possible. That's when you stop being surprised by taxes and start planning strategically. And right now, most retirees aren't seeing it until January 2027 when they file their taxes. Don't be that person. Don't be the retiree who claims Social Security at 62, keeps working, and gets blindsided by an 85% effective tax rate on your COLA increase. Don't be the person who thinks Social Security is tax-free, only to discover up to 85% of your benefits are taxable. Don't be the one caught off guard by Medicare IRMAA surcharges triggered by the exact same income calculation. And don't be someone who misses the strategic planning window, the Roth conversion years, the threshold sweet spots, the claiming age optimization that could save you $26,000 over a decade. The thresholds are frozen since 1984. Inflation isn't that gap costs millions of retirees thousands every January. Understand the combined income formula. Know where your threshold is. Plan before you claim. Don't be that person. The math is the message here. Frozen thresholds, frozen since 1984, mean up to 85% of your Social Security benefits can become taxable income. A January COLA increase that looks like a raise often triggers hidden federal taxes and Medicare surcharges totaling 85% of that increase. The message: understand the combined income formula, know your thresholds, and plan strategically. The math reveals your true retirement picture. Understand it, plan around it, and share this with anyone in your life approaching retirement or already receiving benefits. This impacts nearly 3 million people this year alone. It's likely to impact you or someone close to you. Now you know the formula. Now you can prepare. This is your moment to understand how Social Security taxation actually works, to see the combined income calculation in action, and to recognize when inflation pushes you into higher tax brackets. The frozen thresholds from 1984, the two-tier system, Medicare IRMAA trap. You've seen all of it. Now it's time to prepare. Calculate your own combined income. Review your last 1099-R. Estimate your 2026 impact with the COLA increase. Download the calculator. Do the math for your situation. Because understanding the formula is only the first step. Preparation. Taking action with this knowledge is where your tax savings actually happen. This is scene 219 of 222. We're diving deep into the 4 major Social Security tax impacts that catch retirees off guard. Most people think Social Security is tax-free. It's not. Up to 85% of your benefits can be taxable income. The taxation thresholds haven't been adjusted since 1984, frozen for over 41 years each year. Inflation pushes more retirees into taxable brackets, and January 2026's COLA increase will trigger this for thousands of new retirees. Today we're breaking down exactly how this works, who it affects, and what you can do about it. Comprehensive Social Security Tax Education Video Research completed February 24, 2026. All 4 major angles documented with official IRS sources. Ready for production. This is the critical moment. Most retirees receive their January COLA increase thinking it's pure benefit growth. They don't understand the mechanics. The IRS thresholds: $32,000 for married filing jointly, $25,000 for single filers, haven't moved since 1984. 41 years frozen. Meanwhile, inflation marches on. Each year, more retirees cross into taxable territory automatically. The 2-tier system means up to 85% of benefits become taxable income. Combined, income equals AGI plus 50% of Social Security benefits plus tax-exempt interest. This formula determines everything. When that COLA hits, even a modest 2 or 3% increase, it pushes your combined income higher. And because you're already in the system, that entire increase gets taxed at marginal rates up to 85%. You got a raise, your taxes went up more. That's the trap.